Brief overview of treasury stock buybacks and reissuance. There are many reasons a company may decide to buy back their own shares of stock in the secondary market. One big reason is the need to have shares on hand to settle stock compensation agreements. This is where employees are paid with stock rather than cash. Amazon did this for my sister when they were a brand new company. Needless to say, it's been a very, very good deal for her to be holding that stock this many years out. Another reason is to change the stock price in the market by removing some of the shares. As the supply of shares go down, the price per share should go up. Still another reason is to shield against a hostile takeover by tightening up the control into fewer hands. Some people think buying back shares is a bad way for the company to spend its cash. And some people think it is a great way to get money back to the shareholders, essentially the ones selling the shares back to the company, without paying dividends. When the company buys back the shares are no longer considered outstanding. Just to recap, when the company first starts, it asks the state of incorporation to authorize a given number, a really big number of shares, so that it can issue them in the future. Then when the company issues shares, those shares become issued and outstanding. Outstanding means that the shares are held by owners outside of the company. So when the company goes out to the market to buy its own shares, think of them as coming back to the office and putting those shares they just bought in a drawer. Those particular shares are still issued, but they are not outstanding. Instead, they're in a drawer. This matters because earnings per share is calculated on outstanding shares. So buying treasury shares will always increase the earnings per share because the denominator gets smaller. Also, dividends are only paid on outstanding shares. This makes sense, right? Why would a company pay itself dividends? So the only difference between shares issued and shares outstanding are the shares held in treasury. Accounting for treasury shares is pretty straightforward. We're going to follow what's called the cost method. When the company buys back shares, the treasury stock account is going to be debited for the cost per share times the number of shares. Please note that I did not say anything about common stock or par value here. Neither comes into play in this entry. Debit treasury stock for the cost of the shares purchased and credit cash. When the company resells the shares in the secondary market, it is called reissuing. I know that's confusing because I just said the shares remain issued the whole time, so reissuing doesn't really make sense, but that's what it's called. The company sells the shares back to the secondary market at whatever the market price is at the time. It is likely not the same price as the cost at which the shares were acquired. So what does that do? Well, when the shares are reissued, we credit the treasury stock, making it smaller, by the cost per share that we paid for them times the number of shares reissued. The cash we receive would be the market price times the number of shares. If the market price was greater than the cost, then that extra amount to be credited would go to Paidin Capital share repurchases. This is a new Paidin Capital account. It is not a gain or a loss account. It's a balance sheet account that goes in the equity section. If the market price was less than the cost, then the extra amount would be debited out of Paidin Capital share repurchases if there was a balance. But that account can't carry a debit balance, so if it goes to zero, then anything remaining is going to come out of retained earnings. You have activities that cover the buybacks and reissuance, and then there are activities that cover the retirement shares later in a separate video on that. Make sure you ask questions.